Wars are expensive. But the real winners aren't on the battlefield. Their victory parades aren't televised. Their headquarters are not in bunkers, but in glass towers that define the skylines of global finance. We track the cost of war in lives lost, cities ruined, and trillions spent from national treasuries. But we consistently miss the most important ledger, the one that shows who gets paid, and who gets paid again long after the final bullet is fired. This is not about conspiracy. It is about capital. It is about a system where risk is socialized, profit is privatized, and the financial architecture of a nation's recovery becomes the cage for its future. This is how banks finance wars. And for them, the most profitable phase begins only when the guns fall silent. The illusion is the peace treaty. The handshake, the signing ceremony, the announcement that conflict has ceased. It provides a narrative conclusion the world desperately needs. It allows us to believe the story is over, that the application of violent power has ended. But in the back offices of multilateral institutions and the private credit committees of investment banks, a different assessment is being made. The dossier is not one of military strategy, but of sovereign credit risk, asset valuation, and reconstruction market size. The war's end is not a finale. It is an opening bid. The nation is no longer a theater of combat, but a distressed asset. And distressed assets present extraordinary opportunities for those with the capital and the patience to structure the deal. This is where the silent consortium forms. It is rarely a single entity. It is a network, a multilateral development bank to provide credibility and political cover, a syndicate of private commercial banks to provide the bulk of the capital at market rates, and often a sovereign wealth fund or an export credit agency from a major power to ensure strategic interests are baked into the terms. Their product is the emergency reconstruction and stability loan. It is marketed as a necessity, a technical solution to a humanitarian and economic crisis, and it is. But within that necessity lies the mechanism of control. The loan is not a gift. It is a high-yield, long-duration financial instrument with covenants that reshape a nation. The interest rate is just the headline. The real power is in the conditionalities. These are the non-negotiable rules attached to the money. To access the funds, the borrowing government must agree to what is euphemistically called structural adjustment. This can include the mass privatization of state-owned enterprises, utilities, telecommunications, transportation networks often sold to foreign investors at liquidation prices to generate quick cash for debt service. It includes strict austerity, mandating deep cuts to public sector employment, social services, and subsidies for food and fuel. It includes legal reforms that deregulate markets and remove protections for domestic industries, making the economy perfectly permeable to foreign capital. And crucially, it includes procurement covenants. The billions borrowed cannot be used to hire local firms and stimulate the domestic economy. They must be spent on a pre-approved list of international engineering, construction, and consulting conglomerates. The money flows from the lender to the borrower, and directly out again to the corporate coffers of the lender's own economic ecosystem. The nation gets a new power plant. The foreign corporation books a decade of revenue. The bank collects fees on the transaction and interest on the loan. The debt, however, remains firmly on the books of the nation, now bearing the weight of compound interest for generations. This creates a closed-loop financial circuit. The destruction creates the need for capital. The capital is provided under terms that ensure it is spent with specific corporations. The corporation's profit, the bank's profit, and the nation assumes a long-term liability that ensures its economic policy will be permanently aligned with the creditor's demands. It is the most effective colonization mechanism ever devised, one that is voluntarily entered into, legally enforced, and financially lucrative for the colonizer. The human algorithm of this system is brutal in its simplicity. Consider a civil servant, a mid-level administrator in a ministry. After the war, his department is gutted by austerity mandates. His pension is reformed. His cost of living soars due to the removal of subsidies, and a devalued currency, a devaluation often encouraged to make the country's exports cheaper and its debt payments more manageable in foreign currency terms. The new public hospital in his district is built by a foreign firm, but it is perennially understaffed and undersupplied because the health ministry's operating budget is secondary to the debt servicing schedule. He is living in a state of perpetual economic shock, administered not by a wartime enemy, but by quarterly reports from a credit rating agency. This debt is inheritable. It binds the children and grandchildren of those who lived through the conflict. It predetermines national budgets, crowding out investment in education, climate resilience, and innovation for decades. A country can be rebuilt from rubble, but its ambition is foreclosed upon by a balance sheet. It is a peace defined by permanent constraint, which forces the fundamental question: if the ultimate authority over a nation's fiscal and social policy, the very essence of its sovereignty, is ceded to a consortium of foreign financial institutions, what kind of peace has been achieved? Is it liberation, or is it a leveraged buyout of a nation-state? The bank, as an institution, does not seek territory. It seeks security and yield. In the post-war landscape, it finds the ultimate security: a sovereign client that cannot declare bankruptcy, cannot easily refinance, and is politically desperate. It finds the ultimate yield: a long-term, high-interest stream of payments enforced by international law, and the total dependency of the borrower. This is the silent weapon of the 21st century. It leaves no craters, only spreadsheets. It takes no prisoners, only collateral. Before you answer the question of who wins a war, you must first ask, who owns the debt? We have established the core mechanism, the emergency loan that rebuilds a nation while indebting it for generations. But to understand the full power of the banking system in wartime finance, we must look deeper into the architecture. This is not a single transaction. It is an integrated ecosystem of extraction, where banks act as the central nervous system directing capital to multiple interlocking profit centers long after the conflict ends. The first, and most obvious, pillar is sovereign debt. But this is merely the trunk of the tree. From it branches several other lucrative revenue streams, all facilitated and often financed by the same network of institutions. The second pillar is corporate financing for reconstruction. The banks that issue the sovereign loans also have extensive investment banking divisions. These divisions advise and help finance the very multinational corporations that win the no-bid reconstruction contracts. They underwrite their bonds, manage their mergers and acquisitions, and provide them with lines of credit to operate in the post-war environment. The bank profits twice, once from the government borrower and once from the corporate contractor. It is the ultimate intermediary, taking a fee on both sides of the destruction-rebuild cycle. The third pillar is resource-backed lending. A nation emerging from war, burdened by fresh debt, needs immediate revenue streams. Its untapped or damaged natural resources, oil, gas, minerals, become the most attractive collateral. Banks and their affiliated commodity trading arms step in to offer loans or forward financing deals secured against these resources. The terms are notoriously favorable to the financier, locking in supply at below-market rates for decades. The nation gets a quick cash infusion to service its other debts, but it permanently mortgages its natural wealth. The bank transforms geopolitical assets into a tradable financial product. The fourth pillar is the security finance complex. A stabilized nation must rearm. It needs a new military, new police forces, new surveillance and border control technology. This is not funded through the reconstruction loans directly. That would be too overt. Instead, It is funded through separate defense credit facilities or security sector reform loans, often from export credit agencies of arms-producing nations, backed by the same commercial banks. The bank facilitates the purchase of fighter jets, tanks, and cyber systems from its national defense contractors. The arms manufacturer sells its product, the exporting nation gains influence, and the bank collects fees on the financing, creating another long-term debt stream tied to perpetual insecurity. This is the closed loop. A nation is destroyed. Banks provide Loan A for rebuilding infrastructure, which must be spent with Corporation X, whom the bank also finances. The nation, now indebted, needs cash. So the bank provides Loan B secured against its oil fields, managed by commodity trader Y, an affiliate of the bank. To protect the rebuilt infrastructure and the oil fields, the nation needs security, so the bank facilitates Loan C to buy weapons from defense contractor Z. Each loan is profitable. Each loan deepens dependency. Each loan creates a new vector of control. The brilliance and the horror of this system is its deniability. No single banker seeks to enslave a nation. Each department is simply optimizing for shareholder value. The sovereign debt desk seeks reliable yield. The investment bank seeks lucrative advisory fees. The commodity desk seeks secured supply. Their incentives are perfectly aligned to create a tapestry of financial control. But the intent is fragmented, making it not a crime, but a business model. The human cost is therefore systemic, not incidental. It manifests in what economists call the debt overhang. When a significant portion of national revenue is pre-committed to servicing external debt, crowds out all other public investments. Teacher salaries, vaccine programs,